This one is about scaling startups with blended capital, navigating VC, growth equity, and infrastructure funding. So let's give a warm welcome to the stage our panelists, Lucille Bonnet, Managing Director at Klima Energy Transition, Tushar Kumar, Head of ICS at Just Climate, Gediminas Uloza, Chief Executive Officer at Strioga Family Foundation, and John Coker, General Partner at Eka Ventures. To moderate this session, we welcome Bala Nagarajan, Managing Director at S2G Ventures. Give them a nice warm round of applause. Over to you.
Thank you, Jamie. I'm Bala Nagarajan. I'm a Managing Director at S2G Investments. We're a growth equity investment firm headquartered in Chicago, investing across food, ag, energy, and oceans. I'm excited to be moderating this panel for two reasons. One, you're not going to hear much from me. It's mostly the panelists who are going to be doing the talking. Second, the topic of the discussion here is blended capital, which is how do you grow from venture to growth to infrastructure. And we've put together an amazing set of panelists to invest across this capital stack and bring fresh perspectives. So maybe with that, I'll ask the panelists to introduce themselves. Where do you invest? What's your thesis? And what's your sweet spot? All in less than a minute. Go for it, Lucille.
So I'll start. Hello, everyone. My name is Lucille. I'm Managing Partner at Klima Energy Transition. We're a 210 million euro fund. We're doing growth equity for energy tech companies, mostly in Europe for 80% of the mandate and 20% in North America. So we would invest in all type of technologies accelerating the energy transition, hardware, software, and yeah, so happy to have a talk also with one of you later about that.
Thanks, Lucille. I'm Tushar Kumar. I head up the Industrial Capital Solutions strategy at Just Climate. We are part of a bigger firm called Generation Investment Management. We invest in the growth stage as well in asset-heavy sectors. So somewhere between growth and infrastructure, ticket sizes of at least 30 million, but ideally 50 to 75. Scale up capital for anything that's not bolts, industrial and infrastructure that decarbonizes the world.
Hello, I'm Gediminas, heading Strioga Family Foundation, which is actually a spin-off from an infrastructure investor from Lithuania, Energia. And we have come from the other direction. We've come from the infrastructure investments and renewables development down to willing to become a player in venture capital market. And then basically we have got a foundation with 100 million euros that we would like to deploy in every stage of the verticals, from early stage startups to certain project financing transactions in our ordinary infrastructure. And basically we're blending this whole chain of different investments with our know-how to make all of the investments that we do better in terms of financing and in terms of experience that we can bring together.
Hi everyone, I'm John Coker. I'm one of the founders and general partners at Eka Ventures. We're a pre-seed and seed fund currently investing out of our second fund, which is a $107 million fund. We focus on two things, one very relevant today, one less so. First is what we call sustainable consumption, which is all about decarbonization and resource efficiency in our big consumer supply chain. So we have an investment in the steel industry, we have an investment in home energy management, logistics, direct air capture, and then the second theme is consumer health, which is not for today.
Wonderful. As I promised, this panelist brings perspectives across the capital stack. I was an entrepreneur very early in my life, and one of the first questions the board asked me is, this is great that you've raised venture capital. What does growth mean? What does infrastructure mean? So maybe I'll start with you, Lucille and Tushar. Where does venture stop? Where does growth infrastructure begin? What are the boundaries? Where do the boundaries disappear to some extent?
I can start if you want, Tushar. So I'm very pragmatic about the topic. I think venture stops where venture return types also stop, actually. And it's 2 to 3 times higher than for infrastructure investors normally. So, well, I mean, normally what you typically see is you have early stage venture investor like you, John, coming in, de-risk the technology, get a product market fit. Then you get growth capital, people like Klima, and to a certain extent also you, Tushar. to de-risk the scaling of the operations and commercial organization and get growth in place. And then, well, we have infrastructure investors who are also very much focused on assets normally, and also focus on, well, maybe different type of beast than venture people are focusing on. So more product service versus project and assets for infrastructure. But there is, of course, a blending of all that depending on technologies and business models. And so, well, I mean, we'll discuss later, right? Has this blurred a little bit between infra and ventures? But when I typically see this type of investors investing not necessarily in the same vehicles, first of all, and also not necessarily at the same time. So, in my view, if venture and infra get together in the same vehicle at the same time, probably infra is taking too much risk, or venture is compromising on returns.
Tushar?
Yeah, no, look, agree with what Lucille just said. So I think there are various parameters. You covered the return profile of venture 3 to 5 times, very high, 30% or so or more in terms of returns. Growth's probably high teens to low 20s, mid 20s. Infra probably, depending on the kind of infra, right? High single digits to mid teens if you are adventurous infra. If you take the risk element, then of course you are taking much higher risk in terms of venture growth, lower infra, probably none whatsoever, other than some very select risk. Think of the next, so risk, return, if I think of technology, venture, you're taking a lot of technology risk. Growth, you're largely de-risked. I think we sit in that bucket, so we think of technology risk as largely de-risked. Of course, there is some scale-up risk, etc. that's still there. Infra, zero risk. It should be completely cookie-cutter repeatable, right? So that's your journey. And then commerciality is the other one that I think about. So venture, you're taking a lot of market risk. You're still talking about product market fit. In growth, you need to have some proof of concept already in terms of commercial offtakes or revenues, which says that customers are willing to buy this product or service or whatever you're selling. Infra, of course, you need repeatable revenues again, right? So those are the things. And then the last one, which probably blurs this most in my view. So some of these things, of course, everybody has a different view, but it's the dollars that you're investing in each. And people mostly come at it from a software or maybe asset-light model, where venture, you start with small sums of money, tens of millions of dollars at most, depending on the series. Growth is probably tens to maybe low hundreds. And then infra can be pretty big, depending on the size of the infra, right? Where this equation, though, fails, and that's where some of the confusion comes from, is when you're investing in asset heavy, which is what we do, where you have large green projects, first of a kind industries, projects being built, where you need hundreds of millions of dollars, but they're still very early in that. And how do you actually get around that? So that's where I think some of these lines can blur, but that's how I think about it in terms of risk, return, technology, commerciality, and the dollars required.
Super helpful. I'm sure there are plenty of founders in the room. If I'm a founder, as I'm looking to raise capital across the venture growth, infrastructure, cap stack, John, congrats on closing your second fund. You and Gediminas are seasoned investors. So what mistakes have you seen founders make as they look to transition from venture to growth to infrastructure? What should they be looking out for?
Yeah, I mean, I think the starting point is, we sit on panels like this as the finance industry, and we talk in frameworks that sound very simple. You need to get to product market fit, and then you'll be able to do this, and then you get to this, and you'll be able to do that. And the reality is that for an entrepreneur who's operating at that works at a macro level. When you're operating at a single company level, that is unlikely to be the life that you experience. So it's important to understand that, but it's also important to understand that funding is a scrap, and you've just got to be in the fight the whole time. For some entrepreneurs, they get lucky. They happen to be in a sector that is well funded at the time they're doing it, and they progress through it easily. And their experience of funding sounds very much like we're going to describe it on this panel. For other entrepreneurs, they just have to be constantly raising, constantly looking for new sources of capital. And it's a job. And I think probably the biggest mistake that I see founders make is not or CEOs make is not realize that fundraising is like deeply embedded in the job description, and it's a constant thing that they need to be doing. And they may even go up the stack and back a bit and then up the stack again, just based off what's going on in the market.
What we are seeing that probably not everything goes by the playbook, and it's sometimes in some cases it's very difficult to differentiate. Whether this idea of business or the business that's there, it's already grown to seed A or not, or maybe it's never been going to be grown to seed A, but maybe it's still a good business that could be invested by someone like an odd animal in the room, like us, because we sometimes come in as facilitator or intermediary for those who cannot raise the next round, because the business has some ceilings, but it's still a nice idea. It's still a nice idea that can be deployed with lower growth visibility, and it could become into infrastructure. It could become into a very nice small asset that a family office like us could have for us. So here, I think what we are seeing that there is a very clear tendency how the businesses are supposed to grow. They should go from one round to the other round, to the third round, fourth round, then a unicorn bomb. But most likely it doesn't happen, and I'm really sorry for those businesses who miss the opportunity to actually survive because they're not fit to this staircase. And some of them are still good businesses, but they are not too good or not as good so that they can get to the next round. And then they are just being buried under the other startups of early stage investors because they're just not performing well enough, and the star in the portfolio is not them. So.
Yeah, a board member once said, as a CEO, your job is threefold: always be raising, always be hiring, always be selling. The job of investor is much easier than the job of an entrepreneur. Maybe on that topic, we'll do a quick fire round here. I promise I will not ask any follow-up questions, so you can be as provocative and controversial as you want. In your opinion, what are the subsectors or climate businesses that are overfunded or underfunded in our ecosystem today? Go for it.
Okay. So overfunded is the wrong word. Easily funded, anything to do with efficiency within data centers at the moment.
Sure.
Underfunded, I think the kind of whiplash in the direct air capture market is really unfortunate at the moment. I think it is meaning that companies that have got some really interesting technology find it harder to raise than should be. So that would be my view.
I think from our perspective, we see that anything that has AI attached to it, or anything attached to it with respect to this artificial intelligence growth is, of course, very desirable. And then you have those boring industries, like district heating, for example, which has a lot of potential in improvement, where the founders or startups even not dare to go because they see this as a very old industry, which probably will not deliver the growth, and it will never deliver the growth because there is no vertical that will allow that growth to be that big. And it's a sad story for us because we are missing a lot of opportunities of potential improvements of the old infrastructure in the world, just because these improvements are not AI. They may be, an improvement that would make a lot of carbon saving, but they are not sexy enough today.
Tushar?
Yeah, similar theme. So anything from AI to data centers, I think that we obviously see a lot of money chasing that. May still be right? Given the transformational nature of it. And that is starting to seep through backwards into our world, which is the energy world. So anything that is supplying energy to that whole space is well funded, I would think. And then anything that is hard tech or asset heavy, decarbonization, energy, I think that is not very well funded. We can see that people, in any case, some of these larger projects fall into buckets. So even in the good times, they don't fit growth, they don't fit private equity, they don't fit venture, they don't fit infra. So that was some of our mandate where we said, look, we don't define a bucket while we still have to think through it, but but we can go across these buckets. So that was difficult anyway, but I think in the current point in the cycle, I think we've seen in the last 2 years, anything that people would call hard tech or asset heavy, anything in that space is really, really short of funding.
Overfunded, I'll say battery optimizers in Europe, maybe. I mean, amount of funding is bigger than the market at scale, so that's been a lot. Underfunded, I tend to agree, but more generally, everything that needs more scale and volume to get to the right economics. It's very hard to do. With I think the panel before was really on that. To if you have to build your first demonstration plants, industrial plants, that's super hard for any private investor to go into that risk to get to the right economics, so that you finally get private market fit. So that's hard.
That's fair. I think much of what we invest in as energy climate investors is attached to the physical world. As a consequence, it doesn't follow power law, particularly from a venture perspective. But we've also come through a phase of lots of capital going into software, generally speaking, and now everybody's questioning terminal value of software. So I'm hoping, as a consequence, money will come back into the physical world and then infrastructure world into the climate world. Let's see. Maybe next year when we're here, we'll find out if that happens to some extent or not.
Yeah, we'd love it if it's the other way around.
Yeah, that's true. That's true. Absolutely. Maybe I'll come to you, Tushar and John, in terms of you operate at, to some extent, two ends of the spectrum, which is early stage VC, more growth infrastructure. Early stage VCs want to capture equity upside, knowing there is project finance and infrastructure capital there. Do they underestimate this risk to some extent when you invest? And similarly, Tushar, as a growth infrastructure investor, as much as you aspire for nominal returns, you want higher upside to some extent. So do you underestimate the equity downside in your underwrite, and how do you sort of calibrate around those investment decisions? You want to start?
Yeah, so we probably, we're investing often pre-seed, so there's sort of nothing to review other than the founders and their vision. I think there is so much risk everywhere that it's hard to quantify whether or not we're underestimating or overestimating the project risk. But I think for us, as we experience more companies go through that cycle, we get a much better understanding of how they're going to fund it. And to be honest, the way that we think about risk on day one is like 2 years of runway and without any revenue. And then what can they achieve in that period of time? And then we're very focused on the next round of funding. And that's probably where you start to get a better understanding of what the project financing might look like. Again, I kind of go back to the answer on my first question. It is so people dependent. Sure. The difference that we see in entrepreneurs' ability to navigate complex funding environments is extraordinary for effectively the same kind of business.
Sure. Tushar?
Yeah, maybe one thing that I'll completely agree with is people, and that makes or breaks these investments in terms of how you see risks and how you see these investments de-risk, right? So. And that's across stages. The one asterisk in that perhaps is that the skill sets do evolve sometimes, and sometimes people and founders can evolve into that. At other points, you need to add to these teams to bring those much more diverse sort of skill sets that these companies need as they grow. In terms of underestimating risk, no, we've never done that, right? Never, ever. But look, the reality is we do, of course, and there are lots of. I mean, none of this is something that is unfamiliar, but you still end up doing it, right? Other things around your views on the market growth, your views on how easy the execution is, and then of course you get caught up in the ups and downs, right? And while we all collectively always say we take the long-term view. It is inevitable that some of the recency bias does come into effect, right? So all of those do color your risk views. But the one thing that I think we've learned is that the execution risk is perhaps the one that I would pick up on. That is the most underestimated, and so we're putting a lot of effort into it. And some of that is people, of course, and the skill sets, but some of that is just the underlying real execution that you need, particularly for hard assets. in terms of building things, and that just has proven to be quite difficult across the board. So I think that if I have to pick one thing, that's the one risk that I would pick, where I guess even as experienced investors don't put enough into it. I wouldn't say, I thought when you said what risk VCs underestimate, that's a trick question. I wouldn't say anything against our friends in the VC stage, but look, that is one thing that we as investors across underestimate.
Yeah, I mean, go ahead.
No, I think that is, if I just think about the experiences we've had, when I talked about that 2-year runway, the reality of it actually needing more, that us underestimating how much something is going to cost. This is not a project finance. This is like just getting to a place where you can get to the next stage of funding. And I agree with that.
Absolutely. I think I was told once the ability of your CEO to communicate is inversely proportional to the cost of capital of the company. The better they communicate, the more you can raise at a lower cost of capital, and this is across the capital stack, right? Whether it's venture, growth. So as much as execution is more important, unfortunately, sometimes it's the ability of the CEO to get up on stage and pitch and attract, because we all yearn for good stories, good narratives, want to sort of gravitate towards people who have charisma, and this is equally important to some extent in an early stage. Maybe this is going a little off topic, but have you seen some patterns of like CEOs, especially the early stage, because you're backing a team? Are there like do's and don'ts as you think about what's the right profile of a CEO?
I wouldn't say there's do's and don'ts in terms of profile, because we've seen extremely introverted people be extraordinarily good at fundraising, and we've seen extreme extroverts be very good at it. I think the point is about telling stories. Like, can you get into the head of a venture investor or an investor full stop in the way that they start to, like, it's a story rather than a pitch deck. The delta I've seen over, I've been investing for 20 years, the delta I've seen over my career as to how good fundraisers versus poor fundraisers is extraordinary. And I think actually at the poor fundraising end of the spectrum, the biggest mistake I see there is people blaming the market. It's like, we've got this great technology, but there's just investors aren't interested. And I'm like, there's investors for everything. If you've got the great technology, you'll find them.
Absolutely. Yeah. Maybe let's go from story to bankability. Bankability is what determines whether you grow from growth to infrastructure in particular. Maybe Lucille, Gediminas, from what you've seen, how do you underwrite bankability of an asset class, of a product or a business at the stage at which you're evaluating investments?
So basically, if you go from standard like infrastructure projects, then bankability is determined by the industry norms. So banks come with their requirements. That's the requirements of the BRD, that's the requirements of EIB, and that's the requirements of commercial banks. So you choose, which requirements you would satisfy, and that's it. The issue and interesting market is where we operate, is where the assets are semi-bankable. On the technology side, for example, they have proof of concept, but they don't have the offtake. And basically, without one of these two, the banks would not come. Or otherwise, you might have an offtake, but you would like to try out a new technology, which has not been yet, deployed commercially. And once again, the banks are shying away from those situations. And that's where we, as an family office type of investor, come in and say that, okay, we might give a try because we know the market, even without the tolling agreement or offtake agreement, and we believe in technology. Or other way around, we kind of have the tolling, but we believe that you will make it a good technology. So it's easy to determine bankability for standard projects, which have repeating technology and repeating businesses. But then once the offtake or the technology is new, then you start inventing things, and that's where I really like this territory.
That's super interesting, but it seems like you're taking more risk than a traditional investor, right?
Of course.
Are you getting paid for it is the question.
Yeah, but I think the idea behind our foundation is that we want to make impact. And if we don't make those brave decisions and we don't help those ideas foster, then the impact that we will do will just be monetary addition to the pool. We want to do a bit more. We want to add there where the scarcity is formed because of the norms. And if we break the norm slightly, you might give a chance for someone who has disability today, but the idea and the climate effect of that might be much bigger than if it gets, if it gets verified. So one example that from my previous career, where we just made the first merchant wind farm in a small country of Lithuania, and no banks were actually interested in doing that until someone did it.
Sure.
So once you do the first project with that, then everyone just follows. Well, why haven't we done it before? Just because you were not brave enough, and because you've not tried. So basically, with venture capital as well, you can end up in a situation where then something non-standard is stuck, and it unfortunately dies, unless you have someone taking that extra mile in financing and saying, okay, we'll take the bet.
That's fair. So Lucille, how brave are you on bankability?
Yeah, so in growth equity, we have a little privilege, which is called data. So we do use quite a lot of data. I mean, also for our own equity investment now next to bankability, right? So that's I would say that's less geared toward a team and a vision, and it's more data driven. So a founder has to be very data driven, and it's probably the step before going and see a bank with more data, or potentially longer data sets or bigger data sets. And I think bankability depends probably, first evolving very fast, depending on the technology. If you take BES 2 years ago, you needed a tolling agreement, an offtake. Today, seemingly banks accept merchant risk fully in Europe.
Exactly.
And it's changing and changing and evolving very, very fast. So when we due diligence for bankability on this type of project, we just ask banks, what do they currently want? And I guess that's it, right? The requirements are evolving, also depending on macro conditions, more risk adverse or less risk adverse. So I guess that's the take. And then for growth equity beyond the projects and the real asset financing, of course, working capital does play a crucial role for our portfolio companies. So I mean, strengthening the equity normally is a good way to raise bank financing during that time. So we normally do this as part of a normal equity round.
To bring in a working capital facility to makes
together with
sense,
the blending then that's non-dilutive capital to our equity.
Yeah, it's many companies in the growth phase, and you see a lot of this, Lucille, which is you raise equity, but much of your equity is stuck in working capital, and then you're unfortunately being forced to go out and raise more equity, which is and setting up those banking relationships and the working capital facility as part of an equity raise, there's no better time because you've cash in the bank, and that's the best time to de-risk the business. So
exactly.
It's an interesting take on bankability.
It's not as easy for everyone, right? So
sure.
if you have customers that are in the B2C space, it's difficult. For example, if you have great customer long-term contracts and stuff, it's obviously more easy.
You all have an incredible set of portfolio companies too in your under your firms. Given that you all operate in different parts of the capital stack, maybe I'll start with you, John, because you're at the earliest stage. What is the one company in your portfolio that you would pitch to the growth investors around the table, and maybe go around the table as to what you would pitch to the others?
Well, it's tricky because we obviously don't have favorites, and there's a whole group of companies that are awesome. I'll pick based off stage then more than progress. But and actually the CEO Merva was on the stage earlier today. Company called Hived, which is a logistics play. Focused on the I guess next day parcel delivery using a fully electric fleet, which is a really complicated thing to do, especially actually in the kind of middle mile rather than the last mile. But yeah, they've done a phenomenal job, are now a really sizable business, have very solid recurring customer profile at a very big enterprise level, have navigated the kind of capital stack extremely well, and that's one of those businesses where I think someone mentioned it earlier, you need scale to prove economics, and they've got there now, which is exciting. So.
Also?
Great, sounds good.
You ready to write a check?
Well, it's easy because I did that yesterday with you, right, Tushar?
Yeah.
So Well, we have in the portfolio a company called Mathematics that's doing very granular weather forecast data for the short term, so they head to real time. And to do that, they have the proprietary models, of course, but they also have kind of their ground truth data that they gather with drones going up 6 kilometers up and down into the low Earth atmosphere to make sure they are more precise. And so they sell this to, well, all the supply chain within the energy space, from operation to even distribution, to the logistics sector, to the agri-tech sector, to other type of sectors. Energy being 60% of their market or their revenues today. And I guess that's an interesting one with real assets to fund with the drones. They cover Switzerland with 15 drones, for example, Norway with 30, and with that, that's really helpful to also avoid catastrophe like you've got floatings like in Valencia or in Germany a couple of years ago. People don't know about it. It could be avoided. So.
Tushar, what's your favorite?
Yeah, like John said.
To?
Yeah,
he nearly got you.
That one,
he nearly got you with that.
Yeah, but look, it's like John said, right? It's hard to pick favorites in the portfolio. So I'll use a different metric, which is the smallest portfolio company that we have, just in terms of size, and earliest in terms of stage to the biggest that we have, and they both need loads of capital, right? So. Let's start with the smallest one, which is Meva Energy, which is a biomass to syngas industrial heat company based in Gothenburg in Sweden. It is one where we invested in fairly early. It was just after they had de-risked technologically their core reactor, which converts wastewater into syngas and replaces natural gas for small and medium-sized enterprises. So they put in a commercial facility 2 years ago at a client site, and that we had to de-risk the continuous operation part of it, which is the most difficult thing in this. And now they're almost there. So it's been a very hard, tough journey in terms of technology de-risking followed by operational de-risking, and now they're ready for scale up, right? So that's the kind of things that we really like and invest in, and so there is now a lot of capital needed to just replicate this. We also have some bank funding available, so that's great. So that's one end of it in terms of small decarbonizing real asset, industrial heat, and there is very little competition for something like that. Hydrogen used to be a big story a few years ago, but it hasn't really scaled, at least till now. On the other end is Stegra. We are one of the lead investors in Stegra, the large Swedish green plant. We closed or announced a 1.4 billion equity round. Now this is as big as green projects can get, and that company is another place where we have raised a lot of capital and continue to do so. So that's another one that is really interesting, really shining light in terms of large scale decarbonization. So yeah, we are both in the portfolio, and in asset-heavy world, they always need more capital.
Cool. I asked for one, Tushar gave two. That's awesome. Gediminas, what's favorite?
Yeah, since my colleague just gave two, I will give zero, because we are still in the investment phase and we're looking for those perfect companies. And already from this stack of companies, I see that with Tushar we can really have a good, nice discussion after this, because actually those infrastructure, difficult and time-consuming ideas which need proof and which need patience, they lack funding. And then basically in today's world, everyone wants to get rich quickly. And by doing, syngas project in Sweden with wood waste, it's not going to be quick. No. It's very important. It's very, climate-wise impactful, but you won't get rich of that by just, having an idea today and raising around tomorrow. It's not this kind of business, and that's what I like.
Wonderful. I think we're almost at time, so if you took one thing away from this panel, it is get rich slowly. That's the theme for Energy Transition at the Energy Tech Summit. Please join me in giving a round of applause for our panelists.
Thank you.